Hello, and welcome back to Bonds. This is part 2. So as we said at the end of the last video, we're going to try and get into the nitty-gritty of bonds and the different metrics that are important for calculating bond profitability and whether bonds are worth investing in, etc. Let's kind of think about exactly, well, the fundamentals. What is a bond? What does it look like? Let's try and draw out. Oh, actually, probably best off for me to use the straight line feature over here. There we go. That's much better. It's not great, but it's better. This is a bond. On the side, we've got these little things. This is what they used to look like. They're called coupon bonds. Obviously, it's not done like this anymore, but I'll get to that in a second. Let's just say XYZ company, and we'll say a 10% annual. Bonds almost always pay their interest semi-annually, but let's always start in annual terms, and then we'll kind of break it down later to when it gets periodic into semi-annual. So we'll call 10% annual coupon. A bond. So this is called the coupon payment right here. This is the coupon payment. So do you know what? We'll label it afterwards. Oh, actually, yeah, let's label it now. So that right there is what we call the coupon. That's the coupon rate. That's the coupon interest rate. Coupon interest rate. This over here is the company name. Now, oh yeah, these little things on the side, all of these, those are coupons. Ooh, coupons are spelled with an S, yes, I know. There we go. And basically, oh actually we haven't finished here yet, let's do, here we go, let's do $1,000. Now, this is a $1,000 bond. That basically means how much, that's exactly how much an investor would have to pay today to purchase this bond. So that $1,000 we refer to as the par value, or the face value. It's also called face. Let's put it in. Primarily because it's on the face of the bond, and it's also called the par value because when something is issued at par, it means it's issued at equality, right? If you're on par with someone, it means that you are, on par with them, or you're at a state of equality. So the par value is basically the stated face value of the bond. So we are, going to generally assume a par value of 1,000. If you ever receive a question about a bond and it isn't specific, about what the par value is, assume that it is $1,000. Although any multiple of $1,000 can be used. A lot of the time you might see bonds for $2,000. But the par value generally, represents the amount of money that the firm borrows and promises to repay on the maturity date, which brings us to our next important feature of this bond. The next important characteristic is the maturity date, which is a specified date on which the par value of a bond must be repaid. So instead of putting a date on here, let's just write the amount of time until the maturity date. So let's just write 10 years. Okay. So we're going to call this a 10-year bond. It's being issued at par for $1,000 and 10% annual. So let's just label that 10 years as well. That 10 years, we're going to call we'll call it time to maturity. Time to maturity. Okay, so those are the basic features of any kind of corporate bond or government bond that will ever be issued. Now, let's speak about how these bonds are traded, because this is essentially just a loan. I mean, an investor comes to a corporation and says, all right, I'll buy one of your bonds, I'll lend you this $1,000, give that bond over here, and then what happens over, well, in this case, the next 10 years, is what we do is we snip out one of these coupons with scissors, right? I mean, well, not anymore. It used to be that way. Now it's all done electronically, but way back when, these are called coupon bonds because they used to have little coupons, and each one of these coupons represents a coupon payment that you used to snip off and send in to the corporation, and they used to send you back a check. It's pretty cool. That's why it's called fixed income, because every year you would have this fixed stream of income. Over here, 10% annual coupon interest rate. The coupon interest rate is multiplied by the face value in order to determine the coupon payment. So over here we would have, just kind of, let's, take a magnifying glass and zoom into one of these. It's going to look like this. One of these coupon payments is going to be 10%, right, of the face value. In this particular case, I mean, it's 10% only because it's the coupon rate. 10% times 1,000 face value equals $100. So this is $100 coupon, and you used to send that off to the corporation, and they used to send you back a check with $100, right? So that's kind of how it works. That's kind of why it's a fixed income payment. And then, sorry, fixed income security. And then after 10 years, once all these coupons have been snipped off, you actually send back the bond, the face, and here's your $1,000, and they send you $1,000 back. So you've had $1,000, and you've also had 10 lots of $100. So you've basically made, I mean, if we think about it in simple terms, $2,000. You made $1,000 back on the principal, which is cool. You made $1,000 of profit on these coupons that were being sent back to you. Now, the only thing is that nothing is ever simple in finance, and it's always being compounded, which is a good thing. It makes things a little bit complicated, but it makes things a little bit more profitable. So let's just come down here a little bit, and we're going to speak about how are these bonds traded. Let's try and keep this. Let's try and keep that on the screen as much as we can, just because seeing it will be a lot easier. So let's think about interest rates. What determines? I mean, $1,000, is just about how much the company wants to borrow. So that's just kind of, unanimous amongst companies. All right, this is just what we do. We issue bonds, and we, each bond is in denominations of $1,000. That's fine. 10 years. Well, our financial analysts have decided at the corporation that, we're very happy to keep the money for 10 years, and we'll pay you coupon payments for 10 years. The big question over here is 10%. Where did that come from? Now, the answer to that question is, like we said before, it's the money market. It is the market for funds where interest rates are being decided. Simply because there is a supply and a demand for funds. Here's the quantity and here's the price, or rather the interest rate. There we go. Supply and demand, and this is just the money market. So there's the quantity, let's call it the optimal equilibrium quantity of funds that have been decided, and here is the interest rate. So let's just try and understand this. This is where this 10% comes from. This coupon rate was decided essentially by the money markets. This is obviously very, very simplified, but this is a good way to get the grips on interest rates in bonds. Now, let's think about this for a second. Let's just say that all of a sudden the demand for money increases. So a corporation, or let's just say the whole of America, let's say corporations at large have just decided that they want to increase investment. So the demand curve, as we know, will shift from, let's call this D1 to D2. Now, what happens to the interest rate? Well, obviously the quantity, let's call it Q plus because it's kind of moved over, the quantity has increased, the quantity of money being demanded and supplied has increased, but then if the corporations want more money, then the people that are supplying it can charge a higher interest rate, which makes a lot of sense. Alright, corporations, we will lend you the money that you need, but pay us a little bit more. Aha, okay, now you've got us. Now we understand that. And then let's just roll back, maybe people use a different colour, let's just say that the supply of funds increases, for example. So the supply of funds increases. This means that, you know, wealthy investors kind of have, you know, great confidence in the economy all of a sudden, and, you know, the inclement weather didn't last as long as it should have, and the unemployment figures came out and everyone's very happy, the economy's booming, yes, let's take our money, let's invest in America. Okay, so the supply curve is going to shift from S1 to S2, and what that is going to do is it's going to depress interest rates. Interest rates are going to drop again. I mean, if there's such a huge supply of this product, money, then why should we pay a higher interest rate for it? I mean, if the whole market is kind of saturated and being flooded by this money, there's no reason why we should pay a higher interest rate, and therefore the interest rate will get depressed down, let's say to I minus. Or in this case, it kind of finds its way back to equilibrium again, because if there's a simultaneous demand increase and supply increase, it kind of goes up and then it kind of goes down again. But you get my drift from this. So this is basically where interest rates are being decided.